There is a very big theory that the crashes of 1929, 1969, and 2000 all have one thing in common: a single dangerous trade hiding in plain sight. And today, while everyone's talking about stocks and crypto, inflation, and all this other tariff stuff, almost no one is watching that one trade that could bring it all crashing down instantly. Let me show you exactly what I'm talking about and how you might be able to protect yourself before it's too late. Dalton, our in-house analyst, did a ton of research and came up with a very new PDF that he created for me to explain this Japanese yen carry trade issue. Dalton is a nerd. Dalton put together a 13-page sheet on the carry trade bubbles that have happened in the US. This is a very long sheet. I've read it, and he makes a lot of really great points in here. But for me, I like to look at things from a longer term perspective. Dalton loves analyzing and thinking and talking about these things, and more power to him. But for me, what I like to do is I like to sit there and say, if this worst case scenario happens, how does it affect the businesses that I invest in 20 years from now? Not 20 days from now, not 20 weeks from now, not 20 months from now, 20 years from now. And that's a big part of what I'm trying to get across on this channel, that there's a lot of things going on out there. This carry trade idea makes sense, and it could cause a major disruption in the market, if not a crash. The question is, does it matter? Now, what is this carry trade idea? So I'm going to speak to you guys as simple as possible. The idea of a carry trade is this. If I told you right now you could borrow at 0.5% and you could invest at 4%, would you do it? Of course you would. This would be awesome. So the idea of this is this. You go to a country like Japan, and Japan's current 1-year treasury rate is about 0.5%, like I mentioned. And the US rate is about 4%. So how do you make money between this? Well, you go to Japan and you sit there and you go borrow $1 million. What rate are you going to pay? Hypothetically, 0.5% for 1 year. Then you go to the US and you take that $1 million that you bought and you invest it at 4%. So in 1 year, that $1 million becomes $1,040,000. Then you go back to Japan and you have your $1 million borrowed. They were charged a 0.5% rate. So you owe them $1,005,000. You made $35,000 off of no money. You borrowed $1 million, invested at 4%, paid back at a 0.5%, you made $35,000. Easy peasy lemon squeezy. No risk, right? Well, there is risk. And that's the fear here, because a lot of hedge funds do this. And when they do this, they're taking on lots and lots of margin. They're borrowing at huge levels, like 30, 40, 50, 100 to 1 levels. That is massive amounts of debt. And when they're doing that, there's a big risk: currency fluctuation. And here's why. Let's say you sat there and you borrowed that money at 114 yen per US dollar. You see what happened here? This is the yen to US dollar. In this point, the yen got weaker. So over time, every single dollar got more and more yen. The dollar got stronger, the yen got weaker. If the yen gets weaker though, that's very, very profitable for the trader, because now their $1 million they had, remember, they originally borrowed 114 million yen, which is $1 million US dollars. Now they take their million, convert it back to yen, they get back 150 million. But they only owe the 114 plus interest. So they not only made the spread on the interest, but they also made money on the currency, all because the yen got weaker. What happens if the yen gets stronger? Well, you guessed it, guys. The exact opposite occurs. For example, August 2015, hedge funds out there saying, I'm going to do this. They borrowed 125 million yen. It's 125 to 1. So they borrow 125 million yen. Fast forward, now all of a sudden their $1 million only buys 100 million yen. Oops. Now there's a 25 million yen shortfall. Yes, they made 3.5% spread, but they lost 20% on their money. Magnify that with leverage. 10, 20, 30, 40, 50 to 1. It becomes a disaster. So Warren Buffett has a comment where he says, listen, the 1% sounds unimaginable, but guess what? 1% of the time it happens. Now, I don't know what the chances of these carry trades being disastrous, but the point is they are continuously going in a very large market. Now the question becomes is this the kind of thing that can bury a stock market? There's theories out there that this can make the stock market go down 20, 30% in one day. Now I'm not getting into the fact that this markets would shut down at 7%, blah, blah, blah. I don't know if that's true or not. Again, these are theories out there. What I will say is these are very attractive if they work, but if they don't work, that's where the concern comes. And these hedge funds, they're all about making money on little discrepancies, but on magnitude. They're picking up little pennies, but they're doing it with a lot of leverage. That way it really magnifies those returns. Now, so where's the pain felt in the markets? Well, if all of a sudden these hedge funds have to all get rid of these trades, who's on the hook? Well, they went and borrowed a lot of money from banks. They can't pay those banks back anymore. What's going to happen then? Remember what happened in the great financial crisis? The banks got themselves in trouble from bad loans. That's the theory behind this. And it makes perfect sense. The question is, from a long-term perspective, what does this mean? Now, guys, you've heard me talk about this analogy that I steal from John Hussman. In a room filled with gasoline, there's a fire in the corner. We don't know which spark will cause the explosion, but there'll be a spark that causes the explosion. Could be one of those sparks. This spark of the carry trade could cause so many banks to get tight because all of a sudden they got absolutely burned that it would cause a tightening of money. And whenever you have a tightening of money, you don't have good things happening. Now, couple that with valuations. Guys, we talked about this before. We're currently 100 to 110% overvalued compared to history going back to 1900. That's big overvaluations. Valuations start to matter suddenly and with full force. That could be the issue here. Guys, another spark in the room. Jamie Dimon came out and said he's seeing cracks in our bond market. What he means by that, we've talked about this on other videos. We've sat there and said, listen, we have gotten away with this for a long time. We've compounded the debt. And a lot of people sit there and say, well, it hasn't been a problem yet. Understood completely. But we keep compounding the debt. We keep having these deficits, and that's what he's saying. He's starting to see cracks where people are like, maybe they're not selling the bonds out as fast as they should. Because when the U.S. government needs money, they have a bond offering. Well, it usually sells out pretty quickly, but he said they've been seeing cracks in it. Maybe not as much enthusiasm about our bond market. Now you might wonder, well, why would that be? Well, exactly this. Treat the U.S. economy like you would your neighbor. Your neighbor comes to you and says, hey, I want to borrow some money. What would you ask them? Okay, how much money do you make? How much money do you owe to people? What kind of debts do you have? What kind of assets do you have with your income? And maybe it looks good right now, but you see something interesting. Well, they're able to pay all their debts, but the cost of that debt's going up and they make enough money. They make $100,000 a year, but their costs every single year keep going up and up and up. So their income might be going up 3 or 4% a year, but their debt levels and their debt payments are increasing at 6, 7, 8% a year. Does it take a rocket scientist to realize that at some point there will be a problem? Now, you might give them money when they are spending $20,000 a year, but as it goes higher and higher, there'll be a point where you say, listen, I'm not really keen on that. That's the same issue here. The U.S. has always been the safe haven for the world. But right now, the question is, are there cracks in this that are kind of going, hey, we got to get this thing under control? And like you would advise your neighbor, hey, listen, you're spending a little too much. One of two things has to happen. You need to spend less or earn more or a combination of both. And on these videos, I've said countless times, we need to spend less, we need to earn more, tax it, or grow GDP to get more tax revenue, or a combination of the two. Now, Jamie Dimon recently said in this forum he had, where he sat there and said, listen, the goal is 3% growth, GDP growth. Now remember, that's real GDP growth. You have to add inflation on that. What that means is if inflation's 3.5% and real growth is 3%, the overall growth is 6.5%. He said at those levels, tax revenue is going to skyrocket, people's income is going to skyrocket, and he's absolutely right. But what happens is those people in government love giving their handouts, love both sides of the aisle, love promising their friends things, love promising their constituents things. So if GDP goes up 6.5% on a nominal basis, that includes inflation and all that stuff, then they're going to go try to spend as much of that as they can. That's not going to work. We are at a point now where we have to start paying that debt down. Eventually, it's going to be a problem. And he says in the interview, I don't know if it's 6 months from now or 6 years from now, but it will be a problem at some point unless we turn this thing around. Now, guys, I mentioned earlier in the video about valuations. Guys, It is so interesting to me that we take all these tidbits that people say, this carry trade, this Jamie Dimon talking about cracks in the bond markets, and we focus so much on these things. Oh my gosh, look at tariffs and look at all this stuff. But the one thing that is highly, highly correlated and reliable to future performance is valuations, and that we all fucking ignore it. Not all of us. If you're watching this video, you probably don't ignore it. But we'll get comments in the sections whenever you're talking about valuations. People say, oh, now it's different. And I'm not denying that now is different than 100 years ago. But how much different is it? Here is my valuation going back to 1900 on the S&P using Warren Buffett, that old loser dinosaur who still keeps beating the market. He calls this the most reliable metric at any given time with a negative 0.82 correlation. That's between -1 and 1. 0.82 or negative 0.82 is a huge inverse correlation right here. That means the higher valuations are, the lower returns are. In fact, going back 398 quarters, 100 years, you have to sit here and look at this and go, okay, under 30% undervalued, the average return is 10.7%, not including dividends. And keep in mind, in the history, there's only the average is 6.4, not including dividends. And as we get more and more overvalued, what happens to returns? 10.7, 9.0, 2.1, negative 1.1, negative 1.8, negative 2.3. That's for 50% overvaluation. We're at 105%, guys. We're over double this. So what do the next 10 years look like? Now, there could be ways around this to make it not as bad. How? Massive inflation. If we had massive inflation, it would actually help this considerably. Isn't that interesting? Or massive GDP growth. It's possible. But guys, we're the world's largest economy. How likely is it that we can grow ourselves out of this mess right here? Probably not very likely. That's what I talk about all the freaking time. And yet people continue to say, it doesn't matter anymore. Valuations don't matter. Guys, they matter. They will always matter. Because when you invest $1, no matter what time frame you're in, if it was 1400 or the year 2400, the return you make matters. That is absolutely what matters. And if you can get 4 to 4.5% return on your cash by buying government treasuries, why the hell would you take some other ridiculous return and based on current levels, 3% on the S&P in terms of a equity return if you were to buy all the companies and just hold them in cash? Why would you do that? It wouldn't be worth it. That's not enough premium for there. Guys, this is just math here. There are certain ways around this, but the ways around it have to happen very quickly, and they have to be painful, unfortunately. At some point, this is not me being a fear monger. It's me saying to you guys, the next 5 or 10 years won't be like the last 5 or 10. But when we have these drawbacks and drawdowns, your responsibility as a principle-driven investor is to remember the long run and say, good times don't last forever and bad times don't last forever. We will get through this, and your job is to continue buying the stock market, or if you're buying individual companies, buying great companies at even better prices. Now, guys, if you want to get more breakdown of the stock market GDP, I talk about it all the time. A lot of great investors talk about it. Great PDF we made to explain the stock market GDP, the 10-year cyclically adjusted PE ratio, basically the stock market valuations, how it's changed over time, what it looks like. Our data goes back to 1900. Click the link below. We will email you the PDF for free. You'll get it in a matter of a couple of minutes. Trust me when I say it's worth your time to read. Now, if you know history, back in the 90s, Long-Term Capital Management was a company that used a lot of leverage. These were brilliant guys, all from MIT. In fact, I tease Gary Mashuris, our good friend of the channel, because he went to MIT, and every single time I bring up Long-Term Capital Management, like every single guy was from MIT, and the thing went from literally making 40% a year to going under in a matter of weeks. But the very assets that they bet on, Warren Buffett made an offer on those assets because it was their leverage that buried them. It was the leverage when that happened, the markets plummeted in the short run. But it was at the tail end of a very strong bull market. It was like 1997 or so. So it's still had a few years left in that bull market. But when that happened, it almost buried banks. That's the risk here, the banks. Now, you might be sitting there thinking to yourself, oh my God, if this happens, it'd be disastrous. No, it wouldn't. Because as a principle-driven investor, You should not care about what happens in the short run. You need to care about what happens in the long run. This is our chart going back to 1950, which we've shown on this channel and our other channels over and over. This is a small piece of the things that happen. In fact, the late 90s, they're not even showing that long-term capital management collapse. And it was huge news back then. Huge news. That's the point here. If this were to happen, all it tells you is one of two things. One, that stocks are now cheaper. Doesn't make them cheap. But two, it just goes to show that if stocks fall because of things like this, it's not falling because of fundamentals. It proves that the market price for stocks does not equate to the value of stocks. That's what we're trying to understand and teach on this channel. This principle-driven approach that we're investors, not speculators. We don't look at short-term price movements to determine if we're right or wrong in investing. What we look at is, what are the fundamentals doing? I literally hear all this and it doesn't faze me one bit. And keep in mind, I've been through several bubbles and crashes and I've learned that it all doesn't matter in the long run. What matters is, can you pay a reasonable price for a company today that gives you an adequate return on your capital for the future based on what happens then? That's it. And there's all these things that are going to happen in between. This carry trade could be the spark that causes the explosion. You should look at it as opportunity. Yes, you will take a hit on your net worth. You'll get over it. In fact, if you have extra cash, you will deploy it at much lower levels. That's what a true investor does. They look for opportunity to buy stocks they love at cheaper prices, knowing that the future will be better as long as fundamentals get better. So remember, if you're a follower of this channel, we say, focus low-cost ETFs to hit your financial goals. Anything extra, if you want to buy individual stocks, learn a process. For those of you that are doing this, if this were to happen, keep buying your ETFs and look at the stocks you want to buy and see which ones got affected the most that you could buy more shares of at even better prices. That's the whole goal here. That's exactly what you should be doing. And while this carry trade might be the spark, the real fuel behind the next market collapse is something that is far more dangerous that I talk about all the time: valuation. So click on this video on your screen. We're going to show you just how extreme valuations become, reaching levels that we've never seen before, and why it could derail the entire financial future if you're not ready for how to handle it. Thank you for your time.